Why do most AI trading strategies instantly lose money? Well, if you've ever typed something like, "Give me a profitable trading strategy," into an AI chat window, you probably already know the answer. The illusion of the get-rich-quick AI prompt is incredibly common all over social media right now. But the reality? It's usually just a fast track to a blown account. Welcome to today's Explainer, where we're going to completely dismantle that illusion and solve the core problem of AI trading.
So let's dive right into it, building an AI trading framework, from scientific papers to market regimes. Now don't worry if this sounds a bit intimidating right now. We're breaking this down into a step-by-step roadmap. First up is the trading strategy trap, followed by the AI research hack. Then we'll explore the master regime detector, compare momentum versus mean reversion, and finish up with the final missing ingredient. All right, kicking things off with Section 1, the trading strategy trap. Before we can build something that actually works, we really have to understand why 95% of generic AI prompts and flash YouTube strategies fail to give you a true statistical edge. Why is that? Well, if you just ask an AI to invent a strategy, it basically just strings together logical-sounding indicators that have never actually been backtested. It looks amazing on paper, but it loses real money. And the exact same goes for most social media strategies. They rely way too heavily on the trader's personal discretion and gut feeling, which, let's be honest, you just can't code or test reliably. If you can't strictly test a statistical edge, you're not trading, you're just gambling.
Which brings us to a massive turning point. Section 2, the AI research hack.
To demystify the incredibly complex process of building a quantitative strategy using AI, we have to contrast that standard, failed approach, just chatting with an AI for a generic strategy, with a true research hack. This hack involves taking an AI, in this case Claude, and instructing it to synthesize over 60 highly technical academic papers from a scientific archive. But here's the real secret. You tell the AI to compile all of that into a strictly structured 25-page PDF document. This simple format constraint actually forces the AI to stop acting like a chatbot and start acting like a senior quantitative researcher. And the results? The AI didn't just spit out a single generic rule. No way. It built a massive 16-section document. It literally generated objectives and methodology, a full literature review, a core thesis with a regime framework, a detection engine, and specific sub-strategies. It took 60 scientific papers, which, by the way, would normally take a human like 5 years to deeply understand, and it organized all that knowledge logically in about 15 minutes. It's an absolute game changer.
Let's move right into Section 3, the master regime detector.
I want to slow down here for a second because this umbrella concept is what makes everything else function. The fundamental truth we need to accept is that the absolute #1 strategy killer is the market regime. A market regime is simply the current environment of the market. And a strategy that prints money in a trending market will get absolutely slaughtered in a ranging sideways market. The conditions that make a strategy win simply disappear when the market changes its behavior. And on fast timeframes, like a 15-second chart, that behavior can flip multiple times a day.
You see, the market isn't just one continuous thing. It's actually 4 different beasts. A trend-following strategy might work beautifully in a calm, trending market, but it will get utterly destroyed in wild or ranging environments. You literally cannot build one single strategy to beat all 4 of these worlds.
So how exactly did the AI solve this? Well, it designed an umbrella control point, a master regime detector. Here's how it operates in 3 simple steps. Step 1, it continuously reads market direction and volatility. Step 2, it determines exactly which of those 4 regimes we're currently in. And Step 3, it hands the wheel over to the correct specialist strategy for that specific environment. It's going to deploy either momentum or mean reversion. Basically, it reads the weather before deciding which vehicle to drive.
And that flows perfectly into Section 4, momentum versus mean reversion.
Let's break down those 2 specialist sub-strategies that our umbrella actually deploys when the time is right. Momentum gets the green light in a trending market. It looks for a breakout and bets that the move is just going to keep going. Conversely, mean reversion gets deployed during quiet ranging conditions. It fades the displacement, essentially betting that an overextended price is going to reverse back to its average. These are 2 completely opposite philosophies, kept strictly separated by our regime detector.
To make that mean reversion concept instantly understandable, I absolutely love this visual analogy from the research. Price likes to stretch away from its average, but it usually snaps back like a rubber band. Think about it. On a ranging day, when price shoots way too far from fair value, the mean reversion strategy simply bets on that rubber band snapping back to the middle. It's a highly effective concept, but again, only in the right environment.
Okay, Let's pause for a second to bust some jargon, because how these strategies manage risk is absolutely crucial, and it relies on something called the average true range, or ATR. This is a famous indicator that measures market volatility simply by averaging the size of recent price candles. The momentum strategy, which is trying to catch a few massive runs, uses this ATR to mathematically protect its big wins with an adaptive stop-loss.
Let's look at a concrete mathematical example to make sense of this. The standard look-back period is 14 candles. So, the ATR analyzes the size of the last 14 candles to see exactly how wild the market currently is. If the market is moving fast and aggressively, the ATR grows larger, and the strategy automatically widens your stop-loss so you don't get kicked out by just normal market noise. But when the market calms down, the ATR shrinks and your stop tightens automatically. It literally breathes with the market.
Now, the final logic rule the AI coded for these modules is a literal lifesaver, the safety switch. Think about it. What happens if you're in a mean reversion trade, but the master regime detector suddenly notices the market has flipped into a volatile trend? The safety rule is brilliantly simple. Abort immediately. If the specific environment your strategy requires suddenly disappears, you exit the open trade instantly. There is absolutely no reason to sit around and hope.
All of this perfect theory brings us to our final section. Section 5, the final missing ingredient.
Because honestly, no matter how logically sound this AI document is, it is completely worthless without one last crucial element: data. Specifically, 6 years of massive, raw, clean, historical market data acquired from Data Bento. You just cannot validate these complex academic theories on a few weeks of charts. You need years of intraday data to rigorously backtest the AI's logic, to see if the regime detector actually works, and to confirm if those ATR trailing stops genuinely protect your capital over the long run.
Which leaves us with the ultimate question. The AI built the ultimate theoretical framework. It turned decades of scientific research into a master regime detector. But will 6 years of brutal, unforgiving market data actually prove it right? Or will it tear the entire theory apart? That, my friends, is the absolute ultimate test of AI in quantitative finance. Thank you so much for joining me on this explainer. I really hope this structured approach helps you rethink how you research and test your own ideas. Until next time, keep analyzing, keep learning, and I'll catch you later.